Hello to our viewers. I'm Jen Kohls of Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update for the second quarter of 2026. This past quarter, we saw equities and bonds both rebound since Q1. In fact, the S&P 500 posted its biggest quarterly gains since second quarter of 2020, and small cap stocks did even better. Dan, what were the catalysts for this turnaround?
So the biggest catalyst was the easing geopolitical concerns around the war with Iran. So we saw, just recapping, going back to the first quarter for a second, we saw that conflict start in late February. That dragged March considerably lower, meaning the first quarter finished in negative territory for stocks. And then what we saw in the second quarter is, again, easing geopolitical concerns. So we saw progress in all 3 months of April, May, and June. And here at quarter end, we have a tentative peace agreement in place. So, for example, the U.S. allowed Iran to sell oil with a 60-day lease, which helped oil prices, which I know we'll talk about in a little bit. And other catalysts that we saw were, the continuation of strong corporate earnings. So we saw first quarter earnings season wrap up in Q2, very strong, which we've talked about repeatedly. And then we continue to see the artificial intelligence build out, be very strong. And then just lastly on fixed income, also a rebound in the second quarter. And we continue to see very strong corporate credit conditions within the corporate fixed income market.
You mentioned a pending peace agreement with Iran. Let's briefly focus on the links between the war, oil prices, inflation, and monetary policy.
Yeah, there's actually strong links between all of those factors. So again, going back to the war with Iran, we saw oil prices spike in response to that, going from about $70 a barrel pre-war, peaking at about $100 a barrel at some point in the second quarter. And then as of quarter end here, end of June, oil prices are back down to $70 a barrel. But that spike caused a pretty meaningful spike also in inflation, not surprisingly. And with the Federal Reserve, they're on pause, they're on hold as far as further interest rate cuts. And they've specifically cited the higher input costs for energy related to the war. So speaking of the Fed, we did have a Fed meeting in the month of June. It's notable because it was the first Fed meeting under the new Federal Reserve Chairman, Kevin Warsh, taking over for Jerome Powell. And there was a little bit of a notable shift in the language for their release that they did. And they basically kind of removed their easing bias that they had in there previously and referenced a tightening bias, again, related to the higher level of inflation caused by the spike in energy prices. We still think the bar is fairly high for interest rate hikes. Again, it's notable to reference that of the voting members, half of those voting members penciled in one interest rate hike sometime in the second half of the year. But again, we still think the bar is pretty high for hikes from the Federal Reserve because we think inflation will begin to moderate if this peace agreement holds and energy prices come back down.
Another interesting development relates to the Magnificent Seven large cap tech companies. After a period of outperformance from the broader S&P 500, we are now seeing the Mag 7 become the Leg 7. Dan, you want to explain this to our viewers?
Sure, Jen. So we're starting to see some changing leadership within the technology sector, and it really started to surface really in the month of June. So just to define what the Mag 7 is, it's a moniker that references the largest 7 technology names: Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, and Tesla. And as you referenced, those constituents were definitely a leadership group for the past couple of years, and suddenly they've turned into a lagging group. And the issue that's cropped up is a lot of investors are concerned with the amount of spending that they're doing on artificial intelligence and how they're funding that. So up until recently, a lot of that funding was coming from the very strong corporate earnings and excess free cash flow. But recently, they're starting to fund that with external sources of cash. So think of like issuing bonds, so raising capital via issuing bonds, and also selling additional stock, which dilutes existing shareholders. So that created somewhat of a negative story fairly recently, which led to some underperformance. We're not terribly concerned about it because we actually like the fact that the equity markets have broadened out and away from these 7 very large cap names. So the graph that we're showing here kind of breaks that down and shows this a little bit more clearly. So we're taking the technology sector and breaking it into a couple different industry constituents. So the blue line, we're showing semiconductors, the beige line is software, and the gray line is all other artificial intelligence. And you can see from this line here over the past year that the semiconductors have been the clear leader, and they've been the beneficiary of all the spending that these large Mag 7 names are doing. So again, think of all the spending done for NVIDIA chips to build out the artificial intelligence. And software has definitely lagged here over the past year because there's some real concerns about software companies being disrupted by improvements in artificial intelligence. And we think that AI build-out's going to last at least for another year. There's a lot of tech companies saying it's going to take them at least a year, if not two, to build up the supply to keep up with the very strong demand.
With all that said, what is our outlook for the financial markets?
Outlook remains constructive, despite the recent performance that we've seen from the Mag 7, which had been a fairly strong leadership group for a number of years. The biggest thing we're paying attention to that we've talked about repeatedly is just the direction of corporate earnings. And we expect this year to be a pretty strong double-digit year for corporate earnings. And the thing that we've noted in the past is that expectations haven't caught up to the results. So we think as long as there's still some fairly meaningful positive earning surprises, we think that'll continue to drive stocks. We're hoping for a resolution here with the war in Iran and energy prices can moderate. And again, we're not terribly concerned about the Federal Reserve having to resort to interest rate increases to keep inflation under control.
Thank you for sharing your insights, Dan. And thank you for watching. As always, we appreciate your continued trust and support.